Okay, so let's set the scene. It's early 2026, and Palantir stock, well, it's been on an absolutely historic run. What's happening is the market is just completely re-rating the company. It's no longer seen as this niche defense contractor. Now, a lot of people see it as an absolute must-own for institutions, kind of like a new foundational operating system for business. So, today, we're going to look at why. We'll cover the three pillars holding this whole thesis up. First, just the sheer growth. Second, that tech moat they have. And then finally, the price. And the big question we have to ask is any of this sustainable?
All right, let's get into pillar one, the growth. I mean, these are the numbers that really shut down the critics for a while.
Okay, this number right here, this changed everything. 137%. That's the year-over-year growth in their U.S. commercial business. I mean, for years, everyone said they couldn't scale outside of government contracts. Well, this number pretty much proves that wrong. This is the engine right now.
Then there's the rule of 40 score. That's where you add the growth rate and the profit margin together. For a software company, anything over 40 is considered elite. Well, Palantir hit 127. I mean, that level of growth plus profitability, it's just something you almost never see. And look, the rest of the numbers, they all tell the same story. Total revenue is way up. U.S. commercial more than doubled. But the really important part here is the adjusted free cash flow. This isn't growth that's burning through cash. They're actually funding this whole expansion themselves. No debt. And then this happened. Getting into the S&P 500. This was a huge deal because it forced all the index funds to buy the stock. It basically took Palantir from being this, high-risk growth play to a core holding for a lot of big institutions. Okay, so that's the growth. Now for the second pillar, the tech itself. The big question is, why can't somebody else just copy this? Well, the core of their moat is this thing called the Ontology. And it's not just a database. Think of it more like a living, breathing digital twin of an entire organization. It's the thing that knows how, say, a specific part from a supplier connects to a flight delay and how that impacts a customer's order. It's the brain, the logic layer, that actually makes the data make sense. And right here, this is the key difference. A standard AI, it's trained on the whole internet, right? So it can make stuff up, it can hallucinate. But Palantir's AIP, it uses that same kind of AI, but it's grounded in that ontology, in your company's data. So when you ask it a question, it's not guessing. It's analyzing a real, live map of your actual business. And this is how they're selling it so fast. It's called the AIP bootcamp. So instead of a sales process that takes, months or even years, they go into a company and in just 5 days, they have that company's own data working in the system. And the conversion rate on these things, it's around 75%. It's just a total game changer for their business model. And that moat just keeps getting wider. They're automating deployments now with what they call AI FDEs. You can basically think of it as software that does all the complicated setup work that used to take a whole team of expensive engineers. And now with Edge Ontology, they can put this brain, this logic, out of the cloud and directly onto hardware. We're talking robots, factory floors, vehicles. All right, so that's the bull case, the growth, the tech. But now we have to talk about the third pillar, the bear case. Because all of this performance, it comes at a very, very high price. And this is the number that should give anyone pause. A price-to-sales ratio of 102. I mean, that is an extreme valuation. You almost never see that for a company this big in the S&P 500. What that means is the stock is priced for years and years of perfection. There is zero room for any mistakes. And it's not just about the valuation. There are other real risks here. First, Europe's growth has really slowed down, partly because of all the strict data laws over there. Second, you've got powerful open-source AI getting better and better, which could, eventually put pressure on how much Palantir can charge. And finally, they're still very dependent on a small number of really big customers. That's always a risk.
So, this is where we land. This is the central conflict for any investor looking at Palantir. How do you balance what looks like a generational company against a truly historic valuation?
And you can see this conflict playing out perfectly with the analysts. Take Morgan Stanley. Their bull case is $382. They call it maybe the best fundamental story in all of software. But their bear case? $81. And that's all because of the valuation. I mean, that gap between the bull and the bear view, it's just massive. And that really is the question you have to ask yourself. The fundamentals look incredible. The growth is definitely real. But is a generational company worth paying a historic price? That is the entire Palantir thesis in 2026.